This is Richard Dennis. How did he take a dozen or so totally inexperienced people with a maximum training of a month and turn them more profitable than majority of the traders in the market? Today I intend on covering the most important topics, which are: who were the turtle traders? What was their trading strategy and what were they taught? What was the outcome? What would happen if you tried it today? Let's dig in. Let's say this is Richard. To prove his point of being able to teach anyone trading and make them profitable, he decided to recruit some students. How? He posted an ad in the Wall Street Journal and picked out of the thousands only 14 turtles. Those wondering what was the origin of the term turtle trader, the term stemmed from Richard Dennis's comparison between the disciplined training of turtles in a controlled environment and the systematic training provided to his group of aspiring traders. Recruiting. The point of this experiment was to settle an argument with his buddy William Eckhart to prove that anyone could be taught to trade. So he decided to include people from diverse backgrounds, jobs, and history. He also included a series of true or false questions. Here are a few. What was their trading strategy and what were they taught? One important turtle trading rule of the turtle trading strategy was to vary their position sizes based on market volatility. Richard Dennis taught them to use the ATR indicator to calculate volatility and use this to vary their position size. ATR means average true range. They were to take larger positions in less volatile markets and lower their exposure in highly volatile markets. The turtle trading rules also involved using the pyramiding technique rule to maximize profits on winning trades. They added more positions when they are in a winning trade. If the market remains favorable, they bag a lot of profits with a much bigger position. The key to pyramiding success is to keep your risk-to-reward ratio low, which means you should never risk more than half of what you stand to gain or your reward. The turtles were taught to determine ahead of time when to cut losses and move on, and were mandated to always exit once the market reaches its predetermined stop price. They would enter new 10 or 20 or 40-day high for a long position and the opposite for a short position. Their exit signal for profit would be when the market has made a 10 or 20-day new low, meaning if on a long position, then that would mean a change in trend to the downside. Sometimes the strict rules would be frustrating because when you wait for a trend to change, you can miss huge profits like these. What was the outcome? When his experiment ended 5 years later, his turtles reportedly had earned an aggregate profit of $175 million. So can it still be used today? The turtle trading rules are still applied today by big traders. They only risk 1 or 2% of their balance. That dramatically reduces risks and helps you avoid losing significant amounts of money on your account. The ATR is also used today to test how volatile a market is, to know how much to risk and how fast the market can move. The 10, 20 or 40-day breakout doesn't really work after testing it, but after tweaking it a bit with more modern indicators, then it does work. And overall, if you implement strict rules, just like Richard Dennis placed upon his students, you will succeed, because then emotions won't have any way of disrupting your trades. Thank you for watching. This is the Open-Minded Show. Goodbye.